Hello, and welcome to the Zicklin Talks Business Series. I am Bakita Davis Friday, Interim Dean of the Zicklin School of Business, and it's my pleasure to welcome you to today's webinar, Silicon Valley Bank, the Canary in the Coal Mine. Joining me is Gwen Webb, Associate Dean for Executive Programs, who will moderate the question and answer period. And our guest today is Linda Allen, the William F. Aldinger Chaired Professor and Professor of Finance in the Bert W. Wasserman Department of Economics and Finance. Leading the conversation is Larry Zicklin, retired chairman of Neuberger Berman and alumnus, our benefactor and instructor in our programs. Larry, I take it to you.
Thank you very much, Bakita. So these have been interesting times in the banking industry in the last few months. So let me ask the first question, Linda, of you. What's the economic significance of the 17th largest bank in the United States failing, and the first major bank to fail since the global financial crisis of 14 years ago?
Okay, thanks, Larry. And with your permission, I'll even broaden your question and go back perhaps to first principles, because you could ask, what's the significance of bank failures and banks even? What's the role of banks in the economy? Banks clearly, and all financial institutions, but we're going to talk about banks here. And, I asked my undergraduates, what's the business of a bank? And they usually give me something about money and the provision of money, or the holding of money. And of course, we all know that banks don't have any money of their own. And of course, the experience that SVB and Signature banks both had, which was the money flying out the door at a moment's notice, practically. So the idea is, what is really the role of these intermediaries? And the role is that they are the risk absorbers, almost like the shock absorbers for the economy. They stand ready to take on risk that builds up in the economy in the course of economic activity, because we all know that anytime you want to do anything in this world, there's risk involved. There's risk that the business will not succeed. There's risk that interest rates will change unexpectedly. There's risk that is endemic and a part of our lives. The role of the bank is to be the expert in risk management on behalf of their clients, the general economy. In the context of that, that means that the bank has to absorb risk. And that means that the bank is playing with these risky entities, these risky securities. And of course, when you play with fire, sometimes you get burned. The bank's job and the main, if you want, the charter value of the bank is the knowledge they have in risk management. SVB's management did not manage risk properly. And as a result, they rightly went out of business, because the one thing they were providing, they couldn't provide. And that is risk management services. Now you might say, well, why do the banks have to be so risky? After all, it's creating all these crises, and we're very nervous about them. And you might say, well, banks shouldn't be risky. Banks should be risk-free. Well, that's not going to solve the problem of risk in our economy. Risk is like whack-a-mole. If you knock it down in one place, it pops up in another place. The idea is that risk should be provided or gathered, if you will, in a portfolio by the financial sector, because those are the parties that have the expertise in managing their risk. And when they don't do it, they go out of business.
Was that the reason this particular bank, Silicon Valley, was so vulnerable? Is that it didn't manage risk properly?
Absolutely. There's no question about it. And I should say, this is not rocket science. This is the oldest risk in the book. This is interest rate risk management. And we have all kinds of ways of dealing with interest rate risk management. You might say, well, why should a bank like SVB, that had a lot of tech companies holding deposits that can take money in and out and have need for that money, why should they hold long-term securities? There's no problem with them doing so, because they could manage their risk using derivatives. They don't have to match the maturities of their assets and liabilities. They could take positions to manage risk. The only thing is it's costly to do so. So SVB's management took a bet. They took a bet on this long-short portfolio, long secure assets, short liabilities. And when interest rates unexpectedly went up, and indeed continued to go up, because I believe in the summer of 2022, they were thinking that, well, the Fed has finished tightening and they would get away with it. They didn't. They either lifted or they didn't put on any risk hedges, and that ended the banks.
So are we saying that Silicon Valley Bank really speculated with depositor money?
They speculated with shareholder money, really, more so. They didn't speculate with depositor money. They speculated with their stockholders' money, because this is all about the return on, remember, where is the profit in banking? It's the difference between the return on assets minus the cost of liabilities. The longer the asset maturity, the higher the yield, and therefore that spread becomes greater. They basically were trying to build value for their stockholders. They didn't succeed. They did not, they took a bet that failed. That's going to happen in a world of risk. That's going to happen with a fragile, risky banking system. We shouldn't get all excited whenever it happened, particularly in a time like this, because this was not a time of high level of systemic risk. This was not 2008. We had banking system that was highly liquid and was very, even though there were losses, there still are losses, it is not a banking system that is in crisis. That just means that SVB's shareholders lose, but other bank shareholders gain. And that's the way in which these situations work out.
So in 2008, 2009, we had credit risk. We had bad loans, failed loans. This was not the case in 2023.
No.
This was a case strictly of risk management, but not credit risk.
No, I have to say 2008 was also a case of risk management. It was just a different type of risk. But what I'm saying is this, and I think this is really important. Individual banks each are going to take risky positions. That's just the business. If they don't, they go out of business, not because they are unduly risky. It's because they're not making any money. So either way, they go out of business. The optimal solution is not risk-free, is not zero risk. It's to take on a risky position and manage it effectively. In 2008, the difference in 2008 was that we had such widespread losses in the banking system that we had what we call systemic risk, that the entire system was in trouble. Think about it this way. SVB, let's not take SVB, just Bank A and Bank B. Bank A is having trouble. They messed up their risk management. They are looking at insolvency. In a world where there's Bank B, C, D, E that are solvent, they're able to acquire the assets of Bank A at low cost, fire sale prices, great for their shareholders, and the assets and liabilities get reallocated. What happened in 2008 was there were not enough banks B, C, D, and E to absorb all the losses. That's when we have systemic risk. When there's not enough solvent institutions to pick off the assets and liabilities of the insolvent institutions. That's not what we're at now. And that's why I believe that we've created a crisis where there shouldn't have been.
In a way, Linda, isn't the banking system designed to periodically have failures in that the banks borrow short because bank deposits can be withdrawn on a moment's notice, and they lend long, which is exactly what I was taught not to do when I was studying at Baruch.
Of course, you individually shouldn't do it, but the banking system should do it. And why should the banking system do it? Because you and I And all the business people and consumers and governments have a demand for liquidity that the bank system provides to us. That is, we like to hold these short-term deposits. They're convenient for us. We like to take out long-term loans. That's beneficial to us. The banking system's there to absorb that risk of long-short positions and manage it. And it's critical for the growth of the economy that they do that banks or some intermediary provide those services. Because if you and I, let's say you're running a business, or we have a high-tech business, and if this business was limited to ongoing cash flows in order to make investments in R&D and factories and advertising and the like, they wouldn't be able to run their business. We need some entity to be able to provide short-term liabilities to those businesses and long-term loans. That is, to take that long-short position. You shouldn't have done it, Larry, but your bank should do it.
I don't. But let's try it this way. Silicon Valley Bank had 94%, as I recall, of its deposits uninsured, which means 94% of their deposits were over $250,000. Is that a risk that Silicon Valley Bank should have understood and discouraged? Even though those big deposits are very profitable, obviously.
Right, that's certainly profitable. And also remember, again, those deposits went with credit lines. That's what the business of Silicon Valley Bank was, to provide credit to high-tech companies through these lines of credit, which are paid. You take out a $10 million loan with the bank, you don't get a satchel of cash, you get a deposit in the amount of $10 million. That's the way in which, that's what's building all of those uninsured deposits. And again, this is a risk, a liquidity risk that the banks are supposed to be able to manage. And they have many opportunities. You see, the idea is, if Silicon Valley Bank, this was its business model, they were going to be long short, they were going to be having lots of uninsured deposits and making very lucrative credit line loans to those same customers. In order to deal with that, without disappointing their customers, because you tell your customers, oh, well, you know what? We're not making 5-year loans now. We're only making 6-month loans or 3-month loans or whatever. They go out the door, right? So what you say is, okay, we're going to absorb the risk from our customers. That's what I mean by the shock absorbers, the risk absorbers. And now SVB could go into the derivatives market, and with very small amounts, it's not inconsequential, but it cuts into profits, they could buy an interest rate swap, a derivative of any kind to manage their risk exposure. They didn't do that. The problem wasn't the fundamental business model. It was the risk management was inadequate at SVB Bank. I believe, and look, I don't know the management there, and I can't read their minds, but I believe they felt that the Fed was going to be ending its tightening positions and was going to sort of keep interest rates pretty level. And they would have gotten away with it and actually made a ton of money.
One of the things I always tell my own students is, don't bet the business on one decision.
Exactly.
They were betting the business on this. Paquita, I want to turn to you for a second. So Linda lays this out, the mismatch, the risk management. The auditors had to have seen this. Where were the warnings, except on page 128, section 3, footnote 4, which I haven't read? Why haven't the auditors alerted the readers to this problem?
So I'll always go back to the fundamentals like Linda did here. Remember the role of the auditors. The auditors are to provide an opinion as to whether the financial statements present fairly in all material respects the financial position of the company as of the financial statement date. That is more or less the role of the auditors. And so the opinion, we know that KPMG, when they audited SVB and its financial group, they gave a clean opinion because in all material respects, the information in the financial statements reflected the financial position of SVB as of December 31st, 2022. So then one of the questions is asked, well, isn't the auditor supposed to alert us to the fact that maybe there was a risk that they couldn't continue as a going concern? Well, that going concern opinion has to take into account where the company stood as of the financial statement date, but it's also a little tricky, right? Going concern is a prediction. The audit itself is about the activities that have happened in the past as of the date of the financial statements, and auditors can go in on a sample basis and determine that, yes, what's in those financial statements is actually what happened to that point. Going concern says, what do you think is going to happen in the future? And as soon as auditors are able to predict the future, they're probably going to stop being auditors, right? I mean, and even if you believe that they should have had the training or the ability to look at the things that we just heard discussed, the mismatch, or not even the mismatch, the idea that there was this lack of risk management. The auditors are looking for financial statement risks around reporting. They're also thinking about business risks overall. And because of recent changes at the PCAOB in 2019, they're supposed to report on critical audit matters. So things that are complex and subject to lots of estimates. That going concern prediction is extremely difficult to make. And as soon as you say that a company has the risk of not being a going concern, guess what's going to happen? Especially at a bank, right? Well, so you may force the company into no longer being a going concern.
Right, and the auditor will get sued, no question about it.
Either way.
They should because it's not their judgment, it's not their call.
Right.
If you wanted that, Larry, if you really wanted, and I agree with you wholeheartedly, Paquita, you know, we really want to discuss this together because we are both on the same page that this is about the future. Now in finance, we deal with the future. Now I'm going to be obnoxious. In accounting, you deal with the past. But so what I'm going to say is this. If we really want financial statements to reflect the best estimate of what is going to happen in the future, we should make them mark to market. We should make them market value, the entire statement. Now, I know that there's going to be some, wiggle room in terms of some things are difficult to market, and there are all kinds of models that we're going to have to develop to do it. But if we really take your question seriously, Larry, and say, I don't want to have to read page 125, footnote 17b. I want to know, top line, what is the value of this company? That is the way to know it, to look at the market value of equity. But the definition of the market value of equity is the market value of assets minus the market value of liabilities. That's not what our financial statements provide.
So
until we do that, we will not be able to give that forecast.
I don't want to get too deep in the weeds, but I think this subject is worth a few more minutes of our time. Would you point out to our audience that the banks have two kinds of assets? Ones they mark to market, ones that are held theoretically to maturity, and they don't have to mark to market. Could you go through that for a second?
Yeah, and maybe, Matt, you want to put up the slide just so that I think a picture's worth 1,000 words. And so maybe we should take a look at it on the second page, the second. Yes, please. And this is just SVB, and I thank Jingdong Liu, my doctoral student, for preparing this, and she's doing her dissertation on liquidity risk and how banks provide that liquidity risk service to the economy. But what's interesting, is to just look at the red dashed line on the bottom. These are what we call held to maturity assets. That's what we're talking about. The bank has a designation to make. It decides which of the securities that it holds in its asset base should be marked to market. That means valued at the current price, and which can be held at book value. Each bank designates the ones that will be marked to market, available for sale, they're called, And the held to maturity, those are held at book value. Now, generally, what would you think? The bank is going to put the assets that are underwater, that are losing money, into the held to maturity bucket. Because, of course, then they don't have to actually disclose on a top line basis all of those losses. So they're hidden in that held to maturity group. Look at SVB. This is the solid blue line, where this is the median, the red dotted line on the bottom. You can see that's the median holdings of held to maturity assets for the banking system as a whole,
which is under 20%. Under 20%, right?
This for the banking system as a whole is right around 0%. It's under 5% on average, median for banks as a whole. SVB, and this is going back to 2020, quarter two, started to raise their holdings of these held to maturity assets, which were longer term assets that are most exposed to interest rate increases. And at one point, they were almost 50% of the total asset base. That's huge. That's huge.
So just in terms of the financial statements, if you do read the footnotes, which of course every serious investor should, footnote 9 describes in detail the investments and their investment securities. And as Linda indicated, SVB is transferring investments out of available for sale into held to maturity, because in the end, those unrealized losses, and Linda can go into the detail of why they were having unrealized losses, don't have to flow through the P&L. They can be accumulated in other comprehensive income. And the only way you would really know the details is by going to footnote 9 on page 125 of the 10K and looking to see how much have they accumulated in unrealized losses.
Linda.
But this belongs as a top line number, as you're saying, and exactly should be there. Right?
Linda, are you intimating that SVB did this intentionally as they were accumulating these losses? They didn't want to show it, and therefore they put it into the held to maturity, so they didn't have to reflect the losses on page 1?
It sounds like a line out of Casablanca, but I would be shocked if that were not the case. I cannot read the minds of the managers, but I'm looking at this huge run up in the held to maturity holdings just at the time that interest rates were going up. And just in 2 words, what Paquita suggested I say, when interest rates go up, fixed income securities prices, values go down. Think about it. You have a 10-year treasury security that's paying 2% interest. When interest rates go up to 4%, 5%, well, then that mark to market, that valuation is low, is going to go down. Now, an interesting thing, you could say, well, what does it matter? I'm really holding it to maturity. This is the fallacy of the whole concept of hold to maturity. So it shouldn't matter. If I am going to hold that treasury security till maturity, shouldn't matter. I'm going to get my 100 cents on the dollar. But that's not the issue for a bank, which, remember, has long and short positions. So what the bank is doing is essentially financing that 2% earning asset with money that's costing them 5% or 4% or whatever. So their profitability, their P&L, their spread is turning negative. So it is a really insidious thing to even have this category on bank financial statements, but the fact that it's there, then who do you blame for taking advantage of it? This bank obviously took advantage of it.
So historically, we have never shown market values, except on footnote 7, of held to maturity. Are you now saying that you believe every asset held by the bank
and every liability, and every
liability should be marked.
Every asset and liability, everything has to be marked to market.
Marked to market.
So think about this. We're talking about accountants who have to then go and verify the past activities and operations and the financial position of the bank as of the financial statement date. Now we're saying they also have to ascertain the inputs to determine the market values of both their investments and their assets and their liabilities, and opine on whether or not those numbers are fairly presented is as of the financial statement date as well. And if we're talking about uncertainty, that's one of the reasons we resist this in financial reporting.
I understand.
We have a lot more uncertainty.
Thank you for Paquita for presenting the other side. That's the reason we have this. That is exactly the reason. Now, we all know that there are ways around it. We have level 1 assets, level 2 assets, level 3 assets. There are some assets that you could mark to market pretty readily, and most of the securities here in this case are traded, and so there are market prices. That's going to get us into a whole nother area about market pricing and transparency in securities pricing, but that's not for today. There's no question it's going to introduce volatility and aggravation into the life of accountants. There's no question about it. But in my view, the issue is, if we want financial statements to be useful to investors, to depositors, to stockholders, to the public, they should be at least aspiring to that goal. And right now, we don't even aspire to that goal. And we've created this loophole, which is used by banks that are doing this type of activity, and it gets them in trouble. And then we say, well, we didn't want to read the footnotes, but we can't have it both ways, in my view.
Could we have a requirement that held to maturity assets be no greater than X percent of assets?
You see, that's a mistake. I think all of these rules of thumb are mistakes, because who knows, if SVB had taken interest rate swaps, let's say, or options or futures positions to hedge their risk, we wouldn't be having this conversation. They could have had the same very high level of held to maturity assets, but they were hedging their risk exposure. So there's really, I think it's a real mistake to try to run companies from either regulatory or outside positions. You ran a company for your whole career, Larry, and you had to make tough decisions. And so businesses should be forced to make tough decisions and take the consequences of those actions, which is why I think it was a horrible thing for the Fed to essentially socialize gains and privatize gains and socialize losses. Heads I win, tails you lose, by extending deposit insurance to all depositors. This bank got itself into trouble. They ended up, they should bear the cost of that. Otherwise, there's going to be no reason to engage in costly risk management.
I'm sorry, Paquita.
I was just going to say, and this is, I'm the accountant here, but Linda, to that point, maybe we should also talk about the nature of the depositors at SVB, because maybe that wouldn't be the case for every financial institution, but these were
certainly were not.
Yes.
They were not unsophisticated. They were not mom and pop businesses. They were sophisticated investors. They certainly knew what they were doing. And the fact is, in generally, historically, when banks, and again, I'm not talking about 2007, 2008. I'm talking about it in general. Let's go back to the last big time that we had lots of interest rate risk, which was in the 1980s. I'm old enough to remember this. I shouldn't admit to this. But when interest rates suddenly shot up, and Larry, you probably remember, Paquita doesn't.
No. My father told me about it.
Yes, okay. My grandmother told me that. Okay. So when interest rates shot up to the double digits, of course, this whole trade was underwater. And of course, our derivatives markets were less developed then. So it was less, it was more costly to hedge that risk. So we saw that this happening. But so what we're saying here is that, okay, these are positions that get banks into trouble, risk positions that get banks into trouble. What the FDIC generally did in those old days, not the good old days, but the old days, was they would come in and do what we called a purchase and assumption. The bank was really essentially insolvent. That doesn't mean that their depositors have to bear the cost of that. Essentially, they would come into the bank, close it one night. The next morning, it would open under a new name. Depositors did not have any exposure. There was no need to extend deposit insurance to everybody, which carries a moral hazard problem to the general economy. And we went on our merry way. I don't know where the FDIC was in both the case of SVB and Signature Bank.
And First Republic for that matter.
And First Republic got their own their own bailout by their competitors.
Yeah, I'm wondering if the moral hazard is as great as you say, Linda, in this sense. If a bank requires FDIC insurance, let's say it was fully insured, everybody at the bank, every senior officer is losing his or her job. The shareholders are losing all their money. So there really is going to be pain on behalf of those who own or manage the bank. Why shouldn't banks insure the depositors and make sure management is gone? They'll never have a career again when this happens, and the shareholders bear the loss.
But the problem is management doesn't, or banks don't insure the deposits. You and I do. We, the taxpayers, insure the deposits. This is the problem.
Well, the
what we've done is we've created an expectation, and it's not just regarding deposit insurance, it's a general expectation. When businesses get into trouble, in particular financial businesses, then they could go to the public trial to be compensated. And it shouldn't work that way. It's not healthy for an economy, and it's certainly not healthy for me paying as a taxpayer, and I imagine for most of you listening in here.
But the FDIC taxes the banks, in effect, to create this fund.
The FDIC insurance premium has been zero for years. Maybe now it'll go up a bit. I wrote a bunch of papers on FDIC insurance pricing, which would have been risk-based. Think about car insurance or any insurance policy. Let's say I tend to drive a little fast, and I get into a few accidents here and there. So if I do that, if I take risky behavior, I should pay a higher insurance premium. Well, the way in which the FDIC deposit insurance is priced is not at all regarding that. If you have a bank that's taking risky positions, it should pay a higher insurance premium, right? Which is what you would do if you took risky behavior. That's not the way in which FDIC insurance is priced, and it's certainly not enough to cover what we're talking about.
Yeah, but if I'm a depositor at a bank, how much am I supposed to know about the inner workings and the risk and all the rest? After all, when I get into the subway in the morning, I don't check to see if the wheels are properly aligned.
Right, and that's the point. That's the reason why deposit insurance is for the small depositor who is not going to have the sophistication to deal with that. But for these large sophisticated companies that have business relationships with other banks as well, then this is not something that's outside of their expertise. And if it is outside their expertise, then it's incumbent upon them to get risk management advice from their very banks. That's what the banks do. Essentially, SVB was not just a depositor. It was the banker, if you can think about a home bank or the main bank with these high-tech companies. They dealt with them not only in taking deposits, they made loans, they engaged in derivatives transactions with them. They were their intermediary to the world of finance. Part of that is the control of risk associated with liquidity.
And they got lots of warrants on a lot of those new investments. They did. Paquita, I want to go back to you for a second. At the end of 2022, my recollection is Silicon Valley Bank had already absorbed mark-to-market losses of about $2 billion. And I'm assuming when the accountants got in there in January and February, the losses were greater. And they had a capital, as you pointed out to me earlier, of $16 billion. at some point, does the auditor have to say in the financial statements, hey, it was $2 billion on December 31st, but since we've been here, it's another, whatever you tell me, $2 billion, whatever number you mentioned. What is the responsibility of the auditor to bring us up to date on whether or not this is really a going concern?
So auditors do have to consider what you're describing as subsequent events. So material activities that occur after the date of the financial statements. And of course, part of the going concern assessment will take into account those subsequent events. However, the financial statement audit and the work that's been done, the auditors don't show up, first of all, after December 31st. They're there gathering information depending on the scale of the institution, probably at least months before the fiscal year end. Agreed. And they're getting this information, they're testing, they're sampling, they're doing the work that auditors do to determine that as of 12/31, when we present the balance sheet, the P&L, this is the financial position of this bank as of that date. Now, again, the going concern is a prediction, but that opinion is based on all the things that had already happened in 2022. And unless we learn that something that happens in that starts to happen in 23 causes us to think differently about what occurred in 2022, you don't change the 2022 financial statements. They are as what occurred during 2022. So for the going concern, yes, if we start to see accumulating losses, but you'd have to be looking at this, and as Linda indicated, there's volatility. It's not just an entire drop off the cliff. There is volatility in what's happening. There are predictions about what's going to happen with interest rates and the Fed. And so you have to be pretty certain that you do not feel that this company can continue as a going concern throughout the upcoming year. And I don't know that there would have been enough information after the date of the financial statement audit to make that prediction as an auditor.
Well, just one last question on this subject. Does an auditor have a responsibility to say, boy, if there's another 0.5% increase in interest rates, this bank's out of business? Does the auditor have that responsibility if there's another 0.5 point?
Let me not answer for you, Paquita, because I don't know what auditors' responsibilities are. But that's the fallacy is that if that interest rate went up and the bank's management took on offsetting risk positions in the derivatives market, then that would be a non-event. How could we ask Paquita's
yes. And I agree. So what I would like to think, having worked as a KPMG national instructor, onboarding auditors, teaching auditing myself, is that when you set up the audit, you think about the nature of the business, the operations, you compare your client to its competitors, and you look at the macroeconomy, and you start to think about what's the nature of the operations in the business. And then you have conversations with management about how they're approaching the institution's operations and how are they planning to address the risks that are inherent in the business. If anything, I would say that that's probably work that could be better done by auditors, and even starting the audit engagement and then certainly continuing the audit engagement as KPMG did with the client that it's been with for so long. So I agree, Linda is right. I would not look at the fact that interest rates changed a month after the end of the balance sheet date and say, oh, now it's no longer a going concern. If anything, I would think about looking at holistically how the management approaches the operations of the institution and have the conversation. And remember, auditors can't step over into the role of consultants and say, it looks like you need to make some better decisions about those investments that you have. That's not the role of auditors. And in fact, that would violate independence.
Even though, to go back to what Linda says, they look back at the last 6 months, they made no hedging moves to ameliorate the risk. And now you're saying to yourself, if they don't do it and there's another 0.5 point, this is what's going to happen.
But that's the role of consultants. The auditor has to assess, given what happened, do the financial statements present without material misstatements what happened in 2022? Okay. That's what the auditors are doing.
Let me just move on to another allied question. Part of this run on the bank, and remember, again, my recollection is that Silicon Valley lost $45 billion in one day, was information transfer. Social media is so quick now that the word gets around. So my question to you, Linda, is given the increases in speed and the power of social media, is this likely to be even a greater causative factor in the future on bank runs, even if it's only rumors?
I did a bunch of interviews, press interviews, as you would imagine, in the wake of all of this. And I don't know that anybody else has used this term, but I coined a term called a meme bank run. And that's what I think we're seeing here. Because what we have is SVB, and there's actually questions in the chat. I don't know, Gwen, are you going to ask these questions? Because yes. I've been seeing them come up.
Gwen's going to handle that.
Okay, because
we don't trust anybody else but Gwen.
Oh, okay, that's great. Okay, so what there was no question that that Signature in particular was a meme bank run, that there was no connection at all between Signature and SVB. They did not have the same position. They didn't have the same risk position. But in one day, from one zip code in Signature Bank's catchment area, they lost $1 billion. That was the Friday before they went out of business. There is no bank that could withstand a bank run. A bank run is game over. That's the end of the company. And to the extent that we have social media and other social connectivity that is facilitating or passing around concerns, this meme bank run issue may be more of an issue. And I can tell you I'm working on 2 papers on that.
Okay, just one more. Matt, could you put up the slide I gave you? I want to hear Linda's comments on this slide. I mean, if you have a slide, Linda, I can have a slide.
Okay, that's only fair.
See, here's deposit changes from a week earlier, and you see that the small banks are losing deposits, as probably we should expect. And the big banks, probably the big 4 or 5 banks, are gaining deposits. So my question to you is, how much should we worry about this? Because it's the small banks and the community banks and the regional banks that provide local mortgages and loans to small business. What's this effect going to be on the economy?
And I 100% agree with you. And this is what I meant when I said moral hazard has legs, has implications, has snowball effects that we don't even recognize yet. Because what happens now is that what we're seeing is that large banks are expected to be completely, we have that concept of too big to fail. This is even bigger, too bigger to fail, if that's English. And these banks are not going to ever be allowed to fail. If SVB was protected, well, certainly JP Morgan and Citi and all the rest. So it's a natural sort of self-protective mechanism for economic activity to move to the area that has the best government guarantees, especially since these government guarantees are free to the customer. They're not free to the taxpayer, but they're free to the customer. This is what is creating this incentive where we see more and more activity going to areas that have this, this essentially, it's a put on the economy. The Fed and the federal government has essentially given a put to the private sector, saying, okay, you have a bad outcome, sell it to us at par value, just like, and an example of this is the new discount. Did you hear about the super discount window policy that the Fed introduced right in the time period right after Signature Bank went out of business? Was astonished at it because the Fed is not supposed to lend to banks and take credit risk exposure. But what the Fed said with this super discount window is that, okay, we will take your securities that are underwater. We will take those held to maturity securities that are marked at their 100%, their book value, and we will give you loans based on their book value. So we've got a security that's worth 50 cents on the dollar, but you can borrow from the Fed at 100 cents on the dollar. What happened to the rule that the Fed is not allowed? And I believe this is in the, I'm not a lawyer and I'm not an accountant, so I can't tell you where this is in the rule books, but the Fed is not supposed to, only can make loans if they're fully collateralized. This is certainly not the case. What we are rolling down is a very slippery slope. And it worries me. It worries me because we are essentially socializing the financial system.
Are you also worried, and you can take down this slide, Matt, are you also worried about the amount of money that is now rolling into the money market funds, which are not used to provide mortgages and not used for small business and not used in the local community?
Right. So clearly, we have different financial institutions. Of course, it ends up coming back into the banking sector because there are all of these interrelationships between, remember, the money market funds are going to be lending money, are going to be buying the repos, if you will, of hedge funds, of money managers and the like, and banks as well. And that gets recycled into the financial system. But it is part of this overriding shift to a business model that doesn't allow the private firms to compete on the basis of their ability to do what they are supposed to be doing, their one objective, which is to manage risk. The minute we take away the downside to risk management, we lose risk management entirely. There's no incentive for me to manage risk. If you're going to bear my losses, I might as well, bet the bank because you're going to pay my losses. This is going to undermine the whole system of risk management, which is so critical to the economy, because we can't do anything. We can't buy houses. We can't build factories. We can't engage in R&D. We can't have a national defense. We can't provide food stamps. We can't do anything if there isn't a financial system that stands ready to manage the risk of the economy. And that's what I'm maybe Chicken Little. I've cried wolf a bit in the past, but I'm not now in terms of the risk of the banking system. In fact, Matt, if you want to put up my other slide, I'll tell you why I want to give the business back to the banking system, because I think they can handle it. So here, and those of you who do these webinars may remember that Larry and I did a webinar in May of 2020 when everybody was locked down. And if you see, this is, you can see my pointer, right? Matt, yes? Yeah, Larry, you can see it?
No.
Yeah, this.
Yeah, now I see it.
Right, okay, so this is from a paper that I have with Yitang and Turan Bali that got published several years ago. And what it is a measure of what we call systemic risk, macroeconomic systemic risk. And what we found, the top line on this is, we found we could predict macroeconomic downturns, recessions, 6 to 8 months in advance. And we did this in the United States, in Europe, and in Asia. It works throughout the world. It's very robust. The idea is that, see this straight line, this gray line here? Whenever the blue line goes above the gray line, we're looking at risk of a recession. And of course, we saw it in 2007. We saw it right when the COVID pandemic hit. This peak here is March of 2020. But by May of 2020, we were down around here, or here maybe even, I can't even see it, but we were way below the line. The point is that the systemic risk of the economy, the risk of recession, had fallen dramatically. Here we are, let's go now to where we are now. Here we are, this peak here, when we were above the gray line, that is March 2023. That was when SVB, Signature Bank, Credit Suisse, also Deutsche Bank, we had our problems. Before that, the higher peak is September of 2022, interestingly enough, because we also had some problems back then. But the interesting thing is that the line comes down immediately because the banking system is generally healthy. There are some, and maybe even a lot of banks that are underwater, that are technically insolvent on a market value basis. But there are enough solvent banks and liquid banks there to pick off their assets and liabilities in order to allow the entire financial system to continue providing these risk management services to the economy. That's what I'd like to see happen. And I think the Fed and the federal government has to get out of the way to allow the private sector to do that.
Do you think it'll take some more interest rate hikes to take this risk out? The inflationary
Well,
risk?
the interest rate rise is the inflation risk. So I mean, I've been talking about interest rate hikes for a long time. I actually gave a talk, actually in September, I guess, on CUNY, where I said inflation is a tough thing. No central banker wants to start inflation because you generate inflationary expectations, and then it's really tough to get out of those expectations. But so it's always hard to get rid of inflation. But we have two ways: a hard way and an even harder way. The harder way to get rid of inflation is the one we've chosen, which is to cause the economy to fall into a recession, which is why, in parentheses, I don't know why the Treasury and the Fed didn't let these banks go out of business. It certainly could have caused a recession. So, but that's just in parentheses. I don't think anybody's seriously contending that. The less hard way, still hard way, but less hard, is to increase supply to meet demand. What is inflation? Too much money chasing too few goods, classic definition of inflation. But it doesn't always apply, but it's certainly applied now, post-pandemic, when we had supply chain problems, when we had a problem with the great resignation, people not returning to work, the labor force participation down below pre-pandemic levels. Our supply levels are low, but demand is high because of all that money we threw into the system. What we need to do is either reduce demand, and that's cause a recession. That's bad, and that is a harder way to do it. But we could also increase supply and allow some of that inflationary pressure to be alleviated by eliminating the supply chain imbalance.
Gwen, I just want to ask one more question of Linda. Linda, do you hold regulators responsible for anything that happened to Silicon Valley and Signature Bank? Should they be more greatly empowered?
I would be a hypocrite to say I did, because I don't believe regulatory policy actually provides us with any benefits at all. So I certainly don't expect them to to intervene when we would have needed them. What you were asking Paquita about auditors really is better directed towards regulators, because they're the ones who are supposed to be watching on an ongoing basis the banking system. They have a lot more data than even auditors have, and they fail to predict this, because it's not something that you could expect a regulator to predict. So no, I don't hold regulators responsible, because I don't expect much of regulators, so they don't disappoint me then.
Gwen.
Well, as you can guess, there are quite a few questions, and we don't have a lot of time, but there's one that a couple of audience members have asked about. Should there have been closer scrutiny by the auditors and government regulators, given the fact that Silicon Valley Bank had no chief risk officer for almost a year?
Well, I'll just start with the auditor part. You know, auditors, of course, look at the structure, the organization of the entity, of the institution, but of course, it is not the role of auditors to tell the institution how to run and manage its business. It's its job to assess the state of the institution's operations. So I don't know that the failure to have a chief risk officer would have been something that generated an audit concern.
And I agree with Paquita, and I think that the absence of a chief risk officer was more an effect than a cause. Obviously, risk management was not a high priority of this company. The chief risk officer is the head of the division, but there is a division to engage in that. And the fact that they didn't see fit to hire a CRO means that risk management was not taken very seriously at this company, and we see the outcome.
Here is a related question. Is it possible that poor risk management practices of Silicon Valley Bank are more common than might be evident? Are other banks possibly also not managing their risk well enough that we could lead to a broader problem?
I'm sure that there are other bodies buried somewhere in the financial system. But again, I think that my analysis, at least my data, and so I always go to the data, and just again, in parentheses, what this model, this squiggly line that I showed you, is really coming from equity values and the extreme low equity values, the banks that are doing most poorly. And I think the fact that we aren't in an early warning of a recession means that whatever problems of risk management that undoubtedly exist in the banking sector are manageable.
Paquita, Larry, any insights?
No, I'm going to stick with Linda's answer. I think that's a fair answer.
All right, there is a question here for Paquita. Turning to our students, what advice would you have for students who are planning and preparing for careers in auditing?
Sure. One of the things that I would say at the start of an auditing class is that auditors and accountants are business people first. And so really having a deep understanding of the industry that you are examining, understanding the institution itself is an extremely important part of the planning of an audit. And so you might become aware of the risks or the lack of attention to the risks as Linda has described them. So auditors, accountants, we're business people first. And I think it's important to keep that in mind and really double down on that and be aware of how businesses and your clients operate.
And take more finance courses.
I was going to say, in your discussions with them, Paquita, do you emphasize the distinctions between the auditor's functions and the consultant's functions?
Of course, because independence is one of the key tenets of the auditing profession. And so separating those two functions is extremely important. And we talk about that, of course, in auditing classes.
Okay, given that your advice of the auditors is that they have to know basically enough to actually almost serve as consultants while they draw that line and don't step over the border.
It's a tough job, tougher than I think we understand until something like this happens.
Larry, we have one question for you. We are a little low on time, but the title of this webinar asked if Silicon Valley Bank is the canary in the coal mine. Kind of wrapping up and following your discussion with Linda and Paquita, do you have an answer to this question?
Yeah, I think Silicon Valley Bank, Signature Bank, First Republic is the canary to the coal mine, but it also depends on the level of interest rate. Because if interest rates continue to go up, we'll see some more casualties that we don't know about right now. But I would think the accountants, the auditors, the consultants, the managements are all working overtime to figure out how to repair whatever damage has occurred. And my guess is they're taking all kinds of hedging possibilities now, because if they're not, they're crazy.
The good thing is that this is an imminently hedgeable risk. The 2008 credit risk, which was also an operational risk in my view, was not as hedgeable, as if that's a term, as this. So,
but hedging is expensive. It affects profits, and management hates when profits don't meet expectations.
Exactly.
And sometimes they bet the business.
And it's not surprising that we're seeing all these bad earnings reports in the banking sector, because they actually are seeing that they've got to pay up for their hedges. The hedges are more expensive as interest rates go up, and that's cutting into profits, and that's just the way it is. I
think one of the things we're going to see in the near future is the amount of stock that was sold by insiders in some of these banks.
And that adds another whole area of governance or the lack thereof. We should have a conversation.
I think we'll have to leave it there for the moment. I want to thank you, Larry. Thank you, Linda. Thank you, Paquita, for a really interesting, compelling discussion. Next up in the webinar series on May 9th, we have a program on labor unions. Labor unions have a long celebrated history of supporting their members, but their membership has declined. What are the key factors? What are the implications for workers? In exploring these and related questions, Larry is going to be joined by Professor Stephanie Luce of the CUNY Graduate Center and Aaron Brenner of the United Food and Commercial Workers International Union. We are up to the end of the hour. Again, I want to thank you, Larry. Thank you, Linda. Thank you, Paquita.
And Linda, Paquita, I thank you also. Take care.
Thank you, Larry and Paquita. Take care.